US crypto expansion. So in a quarter marked by a lot of market stresses over US tariffs, and we also have seen some relief following the US pause, the digital asset space has seen very similar kind of co-movements with agri markets, with risk sentiment. So I think that really underscores the point that crypto is very much a risk-on asset. It's not quite the equivalent of digital gold just yet. But also at the same time, there are favorable regulatory developments in the US that's also supporting widening of the ownership base and increase interest in cryptocurrencies in general. So in this update, we'll be covering some developments in the US. Zhefeng will be talking about some of the recent policy changes that could favor increased access to cryptocurrencies in the US. There are aspects with regards to infrastructure, with regards to policy developments to pay attention to. Also, for my section, I'll be discussing some recent research that shows that Bitcoin's mining carbon footprint might not be as large as what is commonly believed. We'll take stock some unique features about Bitcoin that could complement the adoption of a renewable energy infrastructure. And last but not least, Radhika should be covering stable coins, which are catching momentum nowadays compared to CBDCs. So she'll discuss about the linkages between CBDCs and stable coins in the case of the US and European Union. So without further ado, I will pass on to Zhefeng to talk about the latest crypto market developments.
Sure, thanks, William. So maybe we can start off with probably looking at some of the price movements, right? So if you look at the current prices of crypto, you have actually Bitcoin now all-time high over $110,000. Then Ethereum, we also saw a very strong price surge now at about 2.6 thousand US dollar. So we believe this kind of sharp increase in prices could be partially attributable to the US dollar depreciation, because as you know, some investors have actually shifted away from USD as an asset class, especially with the recent Moody's downgrade. So historically, we do observe that there is a slight negative correlation between cryptocurrencies and the US dollar index in general. But more importantly, we believe some of the positive regulatory developments, as William has pointed out, in terms of the policy space in the US, could have contributed to this surge in prices. So three key ones to point out. So firstly, we have the appointment of Paul Atkins as the new SEC chair on 22nd April. So this Mr. Atkins, has actually some financial interest in this crypto space. So based on that, we do believe that going forward, his regime would be a much more friendly one versus the previous SEC chair. And secondly, if we look at the overall SEC, they have actually been dropping lawsuits against major exchanges such as Coinbase and Kraken. And last, when you look at overall progress in terms of the crypto regulations, there's actually a clearer path, I would say, with a working draft of a bill that's being circulated among Congress. Right. So we believe all these three policies, I would say, developments kind of point to is actually a more friendly regulatory environment for crypto, especially in the US. And we believe that actually drove, I would say, more or convinced more financial institutes to kind of participate in this crypto space. Right. So if you look at the next slide, we have a couple of the names here, financial brokerage. So if you look at the Morgan Stanley, so actually Morgan Stanley just announced in the start of the month that they will enable crypto trading for retail customers on their popular e-trade platform. Right, and just shortly after, we have Charles Schwab also following suit with a tentative timeline to launch crypto trading platform within the next 12 months. And we believe this is a major development. As you can see, Morgan Stanley, Charles Schwab alone, both of them combined, they manage over 12 trillion of US dollar assets in AUM. So with this easier access, we do see that there could be some potential of a bit of this AUM going into the crypto space. Right? So now I'll pass my time back to William, who will share a bit more.
Yeah, I think you have make an interesting point. So I just recently read that JP Morgan CEO Jamie Dimon says that even though he doesn't believe in Bitcoin, he's not going to stop his customers from trading it. So JP Morgan might be offering something, crypto trading
For
services
sure. Yeah.
going forward. So that's definitely an area to watch out for. So for my section, I will discuss about what we think is Bitcoin's environmental impact. So this was sparked by a question from one of our visiting MBA students looking at Bitcoin and potentially, what is the cost to the environment. So everybody expects Bitcoin to be a negative for environment, partly because of the fact that it uses proof of work mining, right? So there's a lot of computational power that's going on in the Bitcoin network. Why? To secure it against any kind of attack. So how much energy is actually required? So based on the estimates by digiconomists, as much as 175 terawatt hour of power usage per annum. And this amount of electricity consumption is equivalent to Poland's power consumption. So entire country, Poland. So what's even more stunning is that actually power usage has grown very significantly compared to where it were just 6-7 years ago. So if you look at the chart here, you can see that actually power usage has grown at a compound annual growth rate of 38% since 2017. 2017, it was under 20 terawatts hour per year. Now we're looking at 175, 76 terawatt hour. So the reason why that's the case is because power usage scales linearly with the amount of value that's secured by the Bitcoin network. So this is a result that was confirmed by Budish in an article in the Quarterly Journal of Economics. So I highly recommend everyone to look at it. It basically says that as Bitcoin prices rise, the more it rises, the more power is necessary to secure the network. So what that means is, it seems on the surface, Bitcoin is very negative for the environment. There's a lot of electricity consumption being used, far more than traditional payment processing networks. But that's one side of the story. So if you try to look deeper into the carbon footprint of Bitcoin, a very different kind of story may emerge. So back in 2022, the White House Office of Science and Technology Policy, they come out with estimates that around based on the electricity power usage, it could correspond to about 110 to 170 million metric tons of CO2 emissions from crypto globally. The reason why there's a range is because carbon emission estimates are notoriously very difficult to estimate. So the way it is being done currently is based on localization from IP addresses in the Bitcoin network, and then assuming that it corresponds to the average carbon emission for that region. And to be honest, it's very widespread. And there are widespread regional differences. So if you look at this map of the US, right, and this shows basically the distribution of CO2 emissions across different states per megawatt hour, and it's vastly different. So for Democrat states like, for instance, California, they have been pushing on clean energy, huge amount of installation of solar panels. The carbon emission is so low. But if you look at the Midwest states, they have very high carbon emissions because a lot of the electricity is generated from coal-based power. And what is interesting is that since China banned Bitcoin in 2021, most experts believe the proportion of renewable energy usage in the Bitcoin network has dropped because a lot of these Chinese Bitcoin miners were using hydropower. So that means the trend seems to be that towards higher carbon footprint, a very significant carbon footprint for Bitcoin. But research in 2023 make a compelling case that actually Bitcoin could push for further usage of renewable energy far more than what is commonly assumed. And what is that? So that's really depends on the features of Bitcoin mining, which is very unique. But first, let's discuss what is the problem with renewable energy and how can Bitcoin fit inside this picture. So most renewable energy supply, they are available. So for instance, wind, solar, it depends on how much wind there is in the day. It depends on what time of the day you get maximum power output. So it's not entirely consistent. It is highly volatile. So there's a term called the variable renewable energy VRE, which describes the fact that supply coming from renewable energy is highly variable. And what's the problem with it? So the problem is that this variance in supply does not align with the changing demands. For instance, in temperate countries, what has been observed is that there are typically power gluts in the afternoon because you have a lot of sun power, a lot of solar power, but at the same time, not so much energy usage. But towards the evening, just when your solar power is starting to come off, that's when there's a sharp increase in demand, right? Because there's a need for heating and so on and so forth. Of course, it depends on regional climate. So for Singapore, I guess that's kind of the opposite scenario where actually power usage might douse down in the evening. But by and large, the problem of supply not matching demand is real. So there's a well-known California duck curve. So it shows the variation in energy load throughout the day. So the reason why it's called a duck curve is because if you look at the picture over here, it's shaped like a duck. And basically it shows that you have this large undulation in energy consumption. It's making VRE infrastructure very expensive. It's not cost efficient because prices, for instance, during period of when there's a glut, it could even go to negative, right? So that's actually hurts the commercial prospects of VRE providers. So what that means is that there have been need for government subsidies to actually try to booster adoption of VREs simply because of the low cost efficiency. Now, can Bitcoin provide a useful service to this electricity grid in a VRE context? The answer, surprisingly, is a yes. So why is it a yes? So there's 5 unique features of Bitcoin mining. They are very different from typical energy usage in most scenarios. So first is Bitcoin's flexibility of load. What does that mean? That means that Bitcoin miners can spin out and spin down their activity in very quick manner. In sub-second responsiveness, they can do that. So there's actually a lot of flexibility in adjusting the load placed on electricity grid by Bitcoin miners. The second point is interruptibility. So Bitcoin computations, they're not time sensitive, right? You can choose when you want to do it. You can completely suspend it if you want to, and it doesn't affect the overall efficiency of the network because it is fundamentally a decentralized system. There's always somebody else picking up the computation that you just left off. So interruptibility is very, very important for the Bitcoin architecture. And third, there's also portability. So by that, there's no geographic bound for Bitcoin miners. So the Bitcoin miners can choose to locate anywhere of the world, any part of the world, as long as there's internet connection. That also is going to be quite important in terms of why Bitcoin can support the VRE infrastructure rollout. A fourth point that cannot be underscored enough is that Bitcoin is very price sensitive. The mining activity is very price sensitive, right? So effectively, Bitcoin mining is a zero-sum game. It's a lottery. Somebody's going to win the lottery, and usually the cheapest energy sources with the highest computational power wins, right? So very clear case, the not so cheap energy sources, they're going to suffer. They're not going to be as profitable as cheap energy sources. So that's one feature about Bitcoin mining. And lastly, scale agnosticity. You can be a miner of extremely large scale. You can also be just a single machine miner, and actually it doesn't matter in terms of the economics. There's constant return to scale. So by and large, what it means is that if you consider a situation where there is a VRE power supply glut, so it's very simple for Bitcoin miners to roll up, to kind of spin up their machines, to actually make use of the fact that power costs are very low, so that can actually support power prices during periods of time when traditional energy users, they're dormant or they're not using as much power as before. So that actually improves the cost efficiency of VRE infrastructure, potentially the point where actually governments don't even have to introduce subsidies anymore. And also because of the fact that there's perfect competition. Think about it, there's free entry and exit for Bitcoin miners. Everyone is producing a homogeneous good, which is basically the same compute. So the lowest cost producers will always win, and in almost every case, VRE producers are the lowest cost because they are actually tapping the power grid at a time where there's a glut, right? So where prices could be negative or very close to zero. So what that means is that the network will definitely favor the low-cost VRE producers at the expense of the higher-cost conventional power producers. So in the nutshell, these higher cost producers will be driven out of the market under perfect competition. So it could potentially mean that the marginal uh, carbon footprint of Bitcoin mining is very close to zero because of the fact that it's determined by VRE producer, and because it's a perfect market, it's nearly perfect competition. That means that the average carbon footprint will also be quite close to this very low marginal carbon footprint to be competitive. So the net impact is that you could see higher profitability of VRE infrastructure, especially if they have a Bitcoin strategy. They tie up with data centers to locate it close to their power infrastructure, to the generators, that could potentially make a very compelling commercial use case that could also accelerate the rollout of VRE infrastructure across the world. And if you think about it, the portability of this Bitcoin mining means that actually, as the world spins, as sunlight moves from one place to another, you could actually potentially see, Bitcoin miners moving where the sun is, right? So it goes around the globe, and you can consistently get very good, very cheap, very green energy sources to power Bitcoin mining. So what that means is that it could potentially have a lower carbon footprint than average, which was assumed in the previous calculations, and also it means that Bitcoin mining can achieve some kind of a holy grail where you can have net decarbonizing addition of load to the electricity power grid. So in a nutshell, Bitcoin is potentially more green than what everyone thinks. So with that, I'll pass on to Radhika. We'll cover CBDCs and stablecoins.
Thank you so much, Veliang. Okay, so I've just divided my discussion into 5, 6 main points, and I will touch upon what Veliang mentioned about stable coins as well. But just to kickstart, just to take stock on, where countries are, what are they into, especially in the last 1.5 years. And we do know this progress on CBDCs has been a theme that has been really very relevant in the past 3-4 years, for instance. But what we see is that the pace of progress has been steady in this, but there's also a sense that there's limited urgency among the countries to progress very fast, right? So that's why you see roughly about 3/4 of the countries, say about 130 countries, are into the CBDC pool, and of course they're in various stages all the way from considering it to have implemented it. But about 75%, I would say about 2/3 are still, or 3/4 are still in the R&D to pilot stage. To mean they're still preparing, prepping the base, looking at the architecture, what kind of technology should they use, who would be the main stakeholders. Bulk of them are in that stage. To some considering if they want to run some soft pilots, and if it makes any sense for them to roll out further than that. But largely, the number of countries in terms of adoption has stagnated, at least in the past 6 months to 1 year that we've been tracking this entire measure. And perhaps some of that also goes back to the nuances that needs to be worked out when you're considering CBDCs, particularly in terms of privacy, in terms of stability of the system, who are going to be the main actors, architecture, so on and so forth. So that was the first point. Now going on to the second part of the discussion, which is on CBDCs and stablecoins, and might I add here that our report, which will have all of the content that three of us are discussing here, should be out later today. So that will help you give you some additional background on the key points that we are raising here. So CBDCs versus stablecoins, I think the jury is still out. This is really going to be a debate that's going to take center stage this year. So just to very quickly, in terms of stablecoins, it's kind of a convenient asset, I would think, which marries the characteristics of a digital currency, but it also has the price stability because it's backed by reserve asset, right? So it could be gold, it could be dollar, it could be some other fiat currency as well, depending on the adoption. So to that sense, it kind of lowers the volatility that we usually associate with cryptos. And to some extent, I think what is usually said negatively about crypto, which is that it does not have any real world asset backing it, stablecoin has that. So I think that's the big difference. So in that sense, it's a asset or a currency or an instrument that's looked at more favorably, but it still has its own questions of reserves and regulation. So when we look at the world at large, US really stands out because soon after taking office, the current administrator, President Trump, actually signed an executive order where he said that he would like to protect Americans from the risks of CBDCs. So which basically because it questions privacy and sovereignty of the US. Instead, the government might be more, keener to promote the lawful and legitimate, so I quote unquote, lawful and legitimate dollar-backed stablecoins worldwide. So even again, that tells you kind of the country mix of where the different countries are looking at, especially dominant major countries. Coming to the CBDCs, by nature, it's of course a digital fiat currency. It doesn't have any inherent credit risk, but of course the architecture is very important. All the way from, do you want it to be a retail or wholesale nature, to how many actors do you need it to be, and what stage of development, as we discussed in the first point. Then the question always arises on whether it will be only central bank focus, or you will have other intermediaries, including banks, in the final architecture. And then familiar questions that we've been speaking about in each of these bullet points, which is privacy and surveillance. Now, from the US point of view, there's a general distrust also coming from the point of view that if there are any non-US dollar based CBDC networks, it could inherently try and evade the Western sanctions as well. So as of now, I think stablecoins in general are a relatively smaller market than the other counterparts. But looking at where the major countries are moving, we do think that this space is something that should be watched very closely. Coming to the third point, the literature on CBDCs in general continues to grow. In each of these quarterly updates that we do between three of us, and there's another set of our colleagues, you would find each of us touching on the literature that is growing as well. Of course, it is often, if you're interested in it, you should go to the original papers, because that gives you a lot more technical and operational details. Here, I have just mentioned a couple. So one of the ones which I thought is relevant for the real economy meets policy was this paper that IMF has done on implications of CBDCs for monetary operations. Now, it rests on the fact that central banks usually use different instruments for demand and supply of reserves. And if CBDCs are brought into the picture, how will that impact these liquidity monetary operations? So some of the questions will be very relevant when we see these, this space would be, if does CBDCs really replace cash? To what extent? Does it substitute commercial bank deposits? And could it substitute central bank reserves itself, right? So again, that will have an interplay into the interbank market, as well as CBDCs that are held as reserves by the central bank. So again, a lot more details that the paper goes into. The next point, we have done some country-specific discussions. I've picked up on Europe. US, we think, will go slow on CBDCs, like we just discussed in the second point. They favor, right now, the wind is, or they're leaning towards stable coins. And when you talk about Europe, the whole Digital Euro project is about 3/4 in its way. They had a 2-year preparation phase, and we are 3/4 in. It started back in 23, late 23, and I think in the final quarter of this year, you would see some announcements come as well. Now, this 2 years what was it about? It was about getting various stakeholders, especially the central bank, ECB, and the country central banks, national central banks, to kind of create the rule book, select who are going to be the main service providers, test some of the technical aspects, very important. Now, they also plan to engage private sector companies. Now, these private sector companies will not be just banks, but there will also be payments providers, there will be fintech players, there will be research institutes. Try and bring them all on a common platform to just simulate how this digital euro ecosystem is going to look like. Again, very, very important, because if any country, including Europe, as a bloc, tries to operationalize this, you really don't want to have any hiccups. So I think there is a fair amount of time being spent on making sure that the platforms are sound and all stakeholders are in the loop. And the final point here is on we've taken stock and of progress. Here, I just wanted to highlight two. I think China always is important when we speak of CBDCs, because it's quite advanced in terms of the pilots that it has done. Trying to use in terms of retail, trying to pay salaries by way of CBDCs, some benefits by way of CBDCs across different provinces. And here, I will tie this back to the second point, which is that China is also watching out quite closely on US's plans to encourage dollar-based stablecoins. In fact, there was a report by one of the officials recently which said that dollar-based stablecoin could actually reshape global financial systems. So China might also look at, if it is possible to expedite its own CBDCs to kind of face off or compete with the US stablecoins. Now, if it wants to compete, one of the ways it would look at is basically not only domestically expand the usage, but also expand the usage outside. Institutional usage, higher cross-border usage, so on. So this is something that the Chinese authorities are looking at quite closely. And the final point from my end would be, the less spoken about geographies, which is basically the Middle East in terms of CBDCs. We've given a bit of a progress update on UAE. They have plans to introduce e-dirham later this year. And again, just like Europe, just like the other counterparts, they have launched what they call the FIT program, Financial Infra Transform program, 2 years back. Everything about wanting to make the platform, steady. They've studied it into 9 domains and trying to drill deeper in terms of all the aspects that they want to cover, right? Operational, surveillance, privacy, which intermediaries, and so on. So if everything goes to plan, the integration of the stakeholders is in. I think a soft launch might be done later this year, but completed with the stakeholders next year. We'll watch this space closely, and you could do the same as well as we continue to take stock of all of this in our quarterly updates. Thank you very much, and I'll pass it back to William.
All right, thank you, Radhika. So just a heads up to everyone, we have a Q&A chat box open. So if you have any questions on our sections, please feel free to drop a question in the chat box. So Zhenfeng will be in charge of looking at it. So maybe just a question from my side on this CBDCs versus stablecoin debate. So what do you think are some of the risks with regards to stablecoins versus CBDCs, and how do you think the US will be looking at this risk? And also touching on your previous point where China is looking very anxiously at the US dollar-based stablecoins. So there's definitely some concern whether or not the US dollar as a reserve currency is losing its luster in the current environment. So maybe you would like to expand a little bit on that. Like, what kind of stablecoin architecture do we foresee in the future? Is it going to be a multipolar stablecoin, or would the dollar still be the dominant currency in this arena?
Sure. So, let me say on the onset that because I've always focused on CBDC, stablecoins is a space that I've just started to look at, and I guess in previous editions you've commented on that as well. From what I understand, I don't think it's going to be a unipolar stablecoin world. I think countries could, again, US has been very dominant. US is the biggest economy or largest economy in the world. So if it does hope to place dollar as the underlying asset and give stable coins, I would think that will be another route for them to go ahead and expand its usage. But I don't think they'll be alone. I think China has already spoken about, they have not spoken that much about stable coins. They still want to use ECNY, perhaps perhaps a lot of work has already gone into it. But if they think that US usage is going up purely because it's much more fungible, so to speak, that China might also go down that path. At this point, I think stablecoins as an entire market size is just roughly about 227 billion, which is a fraction of where the crypto market is, over 6 trillion, right? So it's not the US markets, which is about 6 trillion. So not very big by size, but the more actors that come in, you would typically see that space expand as well. So I think for a start, it could be some of the major countries, but perversely, if they are the ones who started, you will see more competition step in as well. But I do think we should, or I'll personally be at least spending more time on this in our subsequent editions.
Yeah, I think stablecoins start to become more prominent ever since Trump came to power. So that now the Republicans, they're trying to push a genius bill,
Right.
Which is to provide a regulatory framework for expanding the US dollar stablecoin. So that's an area where I think there's a lot of excitement. Maybe just one final question for Zhen Feng, if we don't have any other questions. What do you think is the potential of inflows coming from an expansion of token trading services amongst US brokerages that in the future?
Well, I mean, if you look at the AUM, that's huge AUM, right? From Charles Schwab's, Morgan Stanley, and as you have rightly mentioned, maybe JP Morgan even might be considering access for their clients into this, crypto space. Well, I think at the start they'll most likely start off with, as I mentioned, more spot crypto, the likes of Bitcoin, and of course your Ethereum at the start. But once you gain more acceptance, clients start to understand that the risk and the asset class a bit more. For sure, I think they could open up to more interesting, I would say, crypto asset class like your tokens. And if you look at the overall AUM there, and these overall brokerages in the US alone, it's trillions, tens of trillions of dollars. And if you consider even 1% of that, that's a huge amount of inflow, potential inflow. These clients could actually participate in this token for sure.
And I think if you look at the difference between tokens and ETF, ETF is pure financial products. Tokens potentially can be used to buy a cup of coffee for transactions in the economy.
Yeah.
So that can actually help foster some degree of cryptocurrency acceptance among merchants, which is very different from just offering it as an ETF products. Right. So with that, we come to the end of our webinar. So we'll be releasing the Q2 update publication fairly soon this afternoon. So if you'd like to read more insights, please refer to that publication. So we'll see you in 3 months' time. Thank you.
Thank you very
everyone.
much.